to another Market Radar podcast. We're recording this on Friday, November 25th. The market just closed a few hours ago, and pretty uneventful week. We are seeing bearish trend on all but one major indexes. Dow Jones closed bullish trend for the second week in a row now. The other ones are slowly following, except for the NASDAQ, which is falling behind quite a bit. We'll have to see how that plays out. Current regime remains stagflation. We are seeing another pretty decent underlying shift, which you'll see in this week's radar report. Let's take a look at the year-to-date performances. SPY is down 15.78%. QQQ down 28.57%, so still lagging behind quite a bit. IWM down 17.64%, and the Dow Jones now only down 6.06%. It's almost there to break even for the year. Next week, Monday, we've got no market moving events. We've got a Fed speaker. Tuesday, we've got Case-Shiller Home Price Index and consumer confidence. Wednesday, we've got ADP employment report, GDP, that's going to be a big one, international trade in goods, Chicago PMI, JOLTS, pending home sales index, EIA petroleum status report, Powell is going to be speaking, and the Beige Book. So Wednesday is a big day. Keep watch for that. Thursday, we've got jobless claims, personal income and outlays, Fed speaker, PMI manufacturing final, ISM manufacturing index, construction spending, EIA natural gas report, and the Fed balance sheet. Friday, we've got motor vehicle sales, employment situation, and another Fed speaker. So we've got a pretty jam-packed week next week, especially Wednesday. Keep an eye out for that. The market will move for sure.
All right, so let's go over the recap of last week. We had building permits come in printing lower with we're at the lowest print since 2020, and the major ROC figures, rate of change figures are still in negative territory. We had the durable goods orders month over month headline come in at plus 1%. So we're still holding that zero territory. We're still holding in positive territory, right? Bouncing off zero. Now we had core durable goods, which is excluding transportation, doing a huge reversal from printing the lowest since 2021 to back into positive territory in this month's print. So again, between durable goods headline and core, we're not seeing the so much recessionary indications just yet that things are quite so bearish as people might be perceiving at the moment. Now we have continuing jobless claims. We flipped this from jobless claims to continuing claims because this jobless claims are again they're what's being reported today, not what's being reported continually, and we are starting to get a bit lackluster in the move. And there is a pickup in continuing claims, while the headline or the regular jobless claims, the initial requests were kind of sitting inside. Those are still under July's highs, and I think it's important that we bring into this because again, this is in the bigger picture more important, right? Because these are people that are continuing to claim jobless benefits. So the more this number rises, the more people are in a hole that are claiming these benefits. So this is very important to look at. And given the lackluster move in the other number, we're looking at this going forward. And this is printing well above July's highs, and we are approaching the March highs, or the March print, excuse me. And the rate of change numbers are sitting in positive territory outside of the year over year figure, which is slowly climbing towards zero. We're at negative 26% still year over year. So still some move there, still some moving to go to get to positive territory, but jobless claims are slowly building higher, continuing, that is. And let's go over United States new home sales. This bounced this week on the drop in or a slight drop in mortgage rates. The year-over-year figure is still down at negative 5.81%. So we're still in negative territory there, but the month-over-month figure is picking up now in positive territory, plus 7.48%. So we'll watch how this moves going forward. But all in all, the new home sales are still well off their highs, and we are still sitting rather near the lows. So it's not like much rebounding has happened here just yet. Now we have the United States crude oil inventories. So we have another negative print here on a weekly basis, and the average that we spoke about last week in last week's podcast is still in positive territory. So this is still going to act as downward pressure in crude prices, even though we had these two decent negative prints. We're going to need to see this average start rolling under zero to give that boost in or boost in buying pressure that we have seen in the past 2 years on crude. We're going to have to see that average dip back into negative territory. Until that happens, this is still going to be, or there's still going to be somewhat bearish pressure on crude prices. And let's go over ES.
Pretty uneventful week in ESA.
Yeah, I mean this is something that we have to um, pay attention to going forward. We got Momo sitting right here. Now ES can grind higher, can go towards Momo, and can actually pull back or go through it. That's going to be the thing that we have to pay attention to. This is the line in the sand for the bearish trend, right?
Mm-hmm.
So we have to watch this and see how the markets trade. And we've been posting on Twitter the last few sessions intraday levels, which you can see here are these white lines. Now, I just want to go over this briefly because I feel like we haven't covered this yet, and we'll do a quick recap or a synopsis on what this is. So these are intraday levels generated off of DDAP on a smaller time frame. And all this is basically level to level, meaning if you clear one level, you should go to the next level, so on and so forth. And if you can't clear that level, you should go back to that other level. That's all this is. It's like a ladder, laddering up and laddering down on an intraday basis. So outside of that, if we disable that and we take a look at the daily trend as a whole, we can see that the overall trend remains bearish. Price has been rising, and we got a little bit of a bid here after the Fed minutes this week. Markets were somewhat seeming as if they were falling apart and reversed rather quickly, and they climbed. Unfortunately, our hedge did expire worthless, so now we are sitting unhedged in the portfolio, and we have upside risk to Momo where our trend could change, where we would have to reevaluate the positioning. But given the current standings at Momo, we likely will attempt to add or resize into some shorts. We'll see how that progresses when we move towards it. And if we even get up here, maybe the market does fall apart. Another key indicator here would be mid vamp, seeing how that trades. Which, if we take a look at, I mean, we could do something like this to get a quick idea of where mid vamp is. Roughly 36 at 39.64. So anything above 39.64 can continue to grind higher, and vice versa. Anything below that will start sending price lower down a lower vamp.
Yeah, and we have been seeing growth come back essentially over the last few months. So I feel like this GDP number that's going to be coming out next week is potentially going to be surprising to some people. When there's all these doomsdayers out here, everyone's thinking the market's going to shit. But in reality, growth could outperform expectations, and that could really take us to Momo or even through Momo.
That's very interesting. Yes, because unfortunately, you say anything bullish right now, you're labeled a contrarian because everyone's been psychologically for everyone's been set up psychologically to believe that higher prices are just not what's going to happen, right? Because everyone that has been calling for these higher prices have been those contrarian people like David Hunter, right? These people that are like, oh, the market's going to melt up, so on and so forth. And now the whole idea of a melt up is just seen as some type of fairy tale.
Mm-hmm.
When in reality, the times where those contrarians were calling for it were uncalled for, right? They made no sense at that point. But now as growth starts building under the surface, and again, there's a big update that's slowly building. You can find that in the weather report this weekend when you check the radar report released this weekend. You'll start to see what's going on. But long story short, if growth does make a comeback, it's going to catch a lot of people off guard. that is the best. One of the the trades where everyone's like, oh, well, you want to bet against consensus, right? The anti-consensus trade where everyone's positioned one way, we're going to go the other way.
Hmm.
That's really the best scenario for that type of setup where everyone's positioned for lower prices and the market just puts in a risk on regime. Maybe it's only a couple of weeks, maybe it's a couple of months, right? And then maybe we go risk off again. That would be that anti-consensus trade.
Hmm.
But that depending right now, we're not there yet, right? We're still risk off. We've been saying we're risk off. We actually came out October 14th with a full thread on Twitter saying, look, risk off, but higher probabilities exist, and we've been going up since then.
Yeah.
And literally, we are now approaching Momo. This is the do or die for the risk off regime. So we're gonna have
Right.
to see how this formulates going forward. But we should also go over bonds because this has been pretty interesting. Bonds are also off their lows,
Right. So
right?
everything's kind of um, backwards to how it's been this past year now.
Right, bonds and equities are now both rallying, right? So simply put, bonds are ripping, yields are dropping, right?
Hmm.
That's what's going on. Yields are falling now. I should say dropping, right? Yields are coming down. Bond equities are going up. Typically, what people are so programmed. Remember what I said earlier about this whole year-long regime that everyone's been mentally structured for is that when yields fall, bonds are going to go up, right? And we are going to have deflation. But in reality, that's not where we are right now. Because even if bonds do go up, right, and yields do fall down, right, that doesn't necessarily mean we are just in deflation because we've been saying this for a while that bonds can have a counter trend move. The more this goes up, by the way, the more people you will trick in the process, right? Everyone's watching TLT. Everyone's got it on their screens. Like, oh, they're like, oh man, when is this going to go? Or more importantly, the guys like us, right? The hungry guys, the guys that want to play big and they want to buy. We want to buy TMF, excuse me. And everyone's like, oh, TMF's already. Like, we take a quick ruler here. Off lows, we're 39% off lows. And I say, oh, I missed the lows. I got to chase it now because maybe from here to Momo, you look at it and you're like, oh my god, it's 47%, right?
Hmm.
So also another thing, remember, you're not trading TMF to Momo. You're really trading TLT to Momo. So if we take TLT, we go from here to Momo, it's 17 times 3. That's really what you're getting.
Hmm.
You're not
And
getting
that's essentially, if we do get a deflation pivot, that's the move we will miss because we're not touching this until we're seeing bullish trend.
right. And
But
you know what?
it's not about timing bottoms. It's about getting the
Yes.
meat of the move. That's what our system is good at doing. That's what pays off. And so we just follow it. There's no point
More
in timing bottoms because you're going to be wrong 10 times in a row if you try to time bottoms. So
yeah.
it's just not worth the trade off there.
It's bullish trend until it isn't, and it's bearish trend until it isn't. Simplest way to look at it. And there's more on the system in a few minutes. We'll go over some more in depth on that. You guys will get to learn some juicy context behind what we are really talking about here. Um, but yeah, let's segue out of bonds and let's go talk about liquidity. So this week we saw liquidity print off last week's high. So we closed last week. We printing down from last week's print this week. We're well off the highs now. We're roughly 30% or so off the highs. We're sitting just above 100. It seems to be that mark that we haven't been able to get under yet, but we are still above that. Call it the uh, risk paradise where things under 7 when this liquidity risk index gets under 70, things start getting real good for equities and whatnot. So when this is above 70, we have to really take caution. We're still way above 70, so anything can really happen here. It's something to keep an eye on, but we are back under the 2020 peak. Again, we were above that just not even a little over a month ago. We were above that was it 2 months now? No, it's a month ago, a little over a month ago. We were above that peak. Now we are well below it and we're slowly dropping. The question is, can we take out 100 and start moving down to 70? That's going to be something we have to watch. But
Hmm. Yeah, a large component, for those that don't know, a large component of this liquidity risk index is the reverse repos, which we have seen the highest reverse repo numbers ever. And as we talked about in our reverse repo podcast, that's money that is out of equities and out of bonds. And now we're seeing that pull back quite a bit. You're seeing that money piling into bonds, piling into equities, fueling this rally that we've been getting. So if reverse repos come down back and bring this liquidity index below 70, because that's a major component of this index, you're seeing that money that was basically just sitting in cash collecting interest from the Fed is now going to be going into assets, going into bonds, and potentially driving that risk on regime that we are expecting.
Right. Or bonds for deflation, or risk on, or equities for risk on. Right.
Yeah,
So
exactly.
that's
So equities
either
risk on,
or.
bonds risk off. And
Right.
by risk off, I don't mean the kind of risk off we're having now. I mean a deflationary risk off. That's when
Yeah.
bonds will rally. But we're really not seeing that right now. We're not seeing deflation occurring. It's especially if we get a GDP number that's above expectations, you can kiss deflation goodbye because
Oh yeah.
the Fed is not going to stop or slow if they see the market is still running hot.
Yeah. That's a good point. Now that's going to come in this week's report, in this week's GDP report, excuse me, and we're going to see how that is reflected into the market at next week's close. So let's go over the system, and more importantly, Aries. Right. We've been speaking about this on Twitter this past week. We've been saying Aries. No one has any idea what Aries means. We hope to clear that up today, and more importantly, why it is so special. Now, before we go into Aries, it's important to understand what Aries is. Aries is a tactical leveraged bond and equity portfolio built around the system Indeed app. So it's pretty much what we've been using personally, right? But it's a little bit more black and white. Now, there is very little room for nuance with Aries. So, if you take a look at our RP, for example, we've had positions so far this year, right? We've been net short, we've tried hedges, we've done a lot of things, right? Um, and in reality, Aries is flat because there's no nuance there. Now, in this case, it it's a better position to be in, right? Because you don't have to do anything. You can just sit there, right? And it's more cookie cutter, meaning you just follow what it says, and there's only, I think, something like what's it, 78 trades in 17 years.
Yeah, it's fairly passive.
Right, it's fairly passive. Now, if you're looking to be more active, when Aries starts kicking up again, we have a way to we're going to use the way that we previously hedged out this type of portfolio, and we're going to introduce that going forward. But Aries is, again, very simple, very straightforward. It is risky. It is not for you to do. This is not financial advice. We're just showing you what we have done and how we have put it on a piece of paper, because it's very hard. Again, I'm going to simplify this. What we've done in the past is not Aries because it's all been so nuanced. But we've gotten very close to replicating those results with Aries, and we can use that going forward as a public display, if that makes sense. Because it's very hard for me to go back over a long time frame and say, look at my performance. Meanwhile, you didn't know what I was thinking along the lines, right?
Hmm.
Meanwhile, I can show you Aries and have a black and white cookie cutter scenario or model and say, look, this happened because of this every single time. There is no, I had this tingling feeling, so I just hedged the shit out of my portfolio. My spy puts hit, right? Like, that doesn't happen with this, which again is why I have steered so far away from showing individual, like, or realized historical gains the way normal people would, is again because it's not something that would be fair to anyone listening and watching, because it's not something you can replicate because you're not me. You haven't seen what I've seen. You haven't done what I've done. You haven't um, been around these scenarios enough to understand why certain things would happen when they would, and you couldn't replicate in real time. So it's not worth even talking about. That's why we came up with Aries. Again, very similar to what we've done in the past, but more vanilla and straight and clean cut to move forward with. So you guys can see what we're doing in more of a real time and very, again, cookie cutter fashion. So I want to bring up the Aries system backtest results. Now, this is against the SPY index to 100. Now, again, you probably can't even see the SPY on this chart because, yes, those returns are that astronomical. Now, again, I have been hesitant from showing everyone this or trying to put this together because I'm afraid that some people will think that this is the get rich quick scheme and they have to do some dumb shit like maybe, mortgage their house into this. And that is the dumbest thing you could possibly do. I would never recommend anyone do that. Your place of living is not a risk asset. Okay. You need to go to sleep at night in a warm bed. You can't be sleeping in the streets. So this you need to take precautions and do as you see fit. Or better yet, don't do any of this at all. This is more of educational purposes and what we do. This is not meant to be advice to anyone that follows. But long story short, this is what the performance looks like. Now you can't really understand what's going on here, so we logged the chart out so you could. Now, this is what Aries looks like against the S&P 500.
Yeah.
As you can see, Aries was flat going into the end of the year. Now, again, this nuance, we did not we haven't been flat this year. Nuance. It's better to easier to have been flat, right? So going forward, we're gonna push the RP into an Aries into 100% Aries positioning once we get into the next regime. This way, you guys can see in real time what Aries is doing in a traded account. But other than that, you can see over the scope here how one is exponentially growing with the other one. But just remember, this is leveraged. Okay. This is leveraged. And I think, Artie, you want to go over some drawdowns?
Yeah. So um, total drawdowns since mid 2005 for the S&P, largest drawdown was 55% in 2008. Largest drawdown for the Aries portfolio was 50% using leverage. And um, right where your mouse is, that's actually the largest drawdown right there from peak to trough. That was
Right.
actually the portfolio longed bonds during that period. And um, of course, there was the bailouts and everything throughout 2008. So bonds completely reversed course. And that was the drawdown that you see there. That's the 50% right there. But in terms of historical drawdowns, other than that, you're looking at, this portfolio takes 30% drawdowns, 20% drawdowns fairly regularly. Yeah, right there. That's probably, I don't remember if that one was. That one might be 35 or 30% drawdown right there. 2016, that's a 15% drawdown there. 2019, that's another 20% drawdown. So this is leverage. This is not for the faint of heart. Someone doing this needs to be able to, like, well, what we do, we stick to the system, we trust the system, so we don't have any emotions. We are able to take these drawdowns because we know the long-term performance of the system. We know the ins and outs of the system. So there's really no point in dwelling over these drawdowns for us. We know the end result, so we just stick to the system. Tells us what to
Right.
do, we just do it. No
And
emotions.
and that's something that's important to also display here, right? So going back in time, I didn't have this because this was not generated historically, right? This can only be seen now. This is a gift and this is a curse in itself. And this is why I previously refused to show this, but I think it's important. I think at the end of the day, everyone should see this because it's just it needs to be seen to understand what's going on. And the curse of this is that you think this goes up forever, right? In the way that it's going. And historically, yes, this has gone what would seem like a straight 45-degree angle up, right? The problem is yeah, if you cannot stomach volatility, this is not for you. And all I've ever done is stomach volatility, which is why in the last podcast I was able to speak the way I was able to speak, because I am a byproduct of what stomaching volatility is, right? Like that's how we have gotten so far is by being able to take that volatility, stomach it, and come out the other side. Now, there's a difference. This portfolio, by the way, is leveraged 3x. We're using this is using you can replicate this using it's using futures, but you can replicate this using TQQQ and TMF, right? So this is long bonds, so TMF, long equities is TQQQ. You could easily do this with futures contracts. You just have to use the futures contract leverage amount on the contracts according to your account size for 3 times leverage, um, and go from there. Now, you can leverage up and down however you please. You can go to 1 times leverage. You can half leverage this.
Yeah,
You can go
you could do way
whatever you
more
want.
than 3 times leverage, but that's just too much for
Nonsense.
us. It's
Yeah,
just
that's nonsense.
not even worth going any more than 3 times leverage. And something else to note, this backtest isn't based off of data that we know today. This our system learns as it goes, and this backtest is taking into account knowledge it has at the time. So in 2006, it's taking trades as it would with information that it has in 2006.
Right.
2012, taking trades it has in 2012. It's not taking trades it has today. So that's something that's very important to note. This is not some cheat back test. Like anyone can go through, I've seen back tests where people are like, okay, if you take options that are this far out of the money on these days, every time this happens, going back 20 years, you're going to make 200,000%. Yeah, but that's bullshit. You don't know that information 20 years ago.
Right.
This
And
isn't
that
one of those
yeah,
bullshit back tests. This is back
yeah.
test knows the information it has at the time.
Right. So if I were to draw a line down the middle and block out the rest of the data, so for example, 2016, everything that happened before 2006 after 2016, if I were to remove that from the data, what Artie's saying is these values here would not change.
Yeah,
Meaning
exactly.
there nowhere I go in history will the values of the prior data change. It's all built off of what's been sampled at this point or before. So it's a progressive learning model, and it builds as time goes on. This huge risk off period, which again, the model's flat, right, will be a factor in how the model trades going forward, because this will be a factor on how well the model can pick up stagflation going forward. So this is a big stagflationary environment. Actually, while you might think, oh, being flat's not good, it's very powerful for the model because the model's now seeing what a stagflationary market really looks like, and it will fine tune the adjustments going forward of how that stagflation is perceived and how and fake outs and so forth going forward, right?
Yeah.
So that's something that's great when we have big events like this. Another big event was 2008. That definitely, because the prior recession, which the model began training before this point. So there's a training set of data that happens before 2006. The model just doesn't blindly start trading in 2006, but it's enough data that we can say, okay, the model has gained enough confidence to start trading now, and going forward will progressively build. So we starts trading right before this 2008 recession and nails it pretty well. I mean, we have this drawdown, but if you look at the drawdown, that peak to trough drawdown, you notice that the starting value, you're not going 50% in the hole, right? You actually made money on bonds, came down roughly still above break even, the $100 mark. Both of these are indexed to 100 as if they started with $100. So you're dipped down a little bit while SPY has shit the bed, and you go on from there.
Yeah.
So
And well, something that is not included in this back test as well is our hedging strategy. We do use options for hedging, which lowers the volatility quite a bit. We aim to lower drawdowns with our option strategy up until at least half the drawdown. So we aim to eliminate half of a drawdown. And
yeah, and
that's something that we will be sharing in the Discord to paying members as we go forward, as we do get risk on or directional risk off regimes in the future. We will be sharing that information, but it's not something we can include in this back test just because of the nature of options. It's very difficult to
Yes.
backtest them.
And that's again, that goes back to that nuance, the thing that I was talking to you about earlier, right? Or
Yeah.
talking to those listening. So the nuance thing is what's gonna put this model ahead of where it is right now. So we're not gonna so the way long story short, there is we're putting the hedging strategy that's put in place here that we've used historically is doesn't catch every drawdown. It's not going to happen. You're gonna get caught in a drawdown, which is why again I say don't do something that's out of your comfort zone. You have to sleep well at night. Don't do anything stupid. This is not financial advice. This is merely what we are doing. Now you can watch, you can do whatever you want, but I'm not your financial advisor, so please consult with a
There,
professional, right?
there's a reason we called this the Aries portfolio. Aries is the Greek god of war and courage. You
Yeah.
need some fucking courage for this because you're going
Better
to
yet,
war.
you need some titanium fucking nuts, okay? You can't just go do this by
Yeah,
yourself.
but let's talk about leverage because there is different ways to do this. This is 3x. Even with
Yeah,
zero leverage using TLT and QQQ only, you still outperform the SPY easily.
you do.
No
Yes, you do.
problem.
Yes.
We actually probably should have gotten a back test of that, but it easily outperforms the SPY, outperforms the NASDAQ just by timing your TLT entries during deflationary regimes.
Right.
That just really propels the compounded annual growth rate of this. So there's that way to play it. There's also two times leverage ETFs, so that's another way to play it. A little bit more risky, not as risky as this. To go higher risk, futures is an option as well. You can go easily 5x leverage with futures. In the money options, depending how deep in the money you go, you can really adjust the leverage amount
Yes.
with options. The possibilities are really endless to fit anyone's risk appetite.
Right. Now,
But
personally,
we're not recommending this to anyone.
right.
Do not do this. This is
Yeah.
just what we do. I'm just saying there's a way to fit this to anyone's risk appetite.
Yes. Now, personally, I use futures, right? Or I should say we use futures in our individual accounts because of concentration risk. When you're trading with larger amounts of money, you don't want it relying on the back of one fund. Now, Direxion, ProShares, whatever, like obviously they seem like they're good companies, right? Like you could read the prospectus, which if you own a leveraged fund and you don't read their prospectus, you're making a mistake. Always read the prospectus. Takes maybe 10 minutes to do. If you can get a summary prospectus and read that quickly just to understand what's going on in the fund. But those are found on the fund websites, by the way. You can easily Google search it will come right up. But long story short is when you're trading with larger amounts of money, the growth that's happened has been so incremental, has been so preposterously compounded that like you don't want to risk some bullshit illiquidity event on some fund to scare. That's why I use futures, right? And I'm not telling you to do that, but I'm just telling you that like the bigger you are, the more concentrated risk you have with one fund. You can try splitting them up across funds, so that's just more positionings to manage. You're better off just, or I'm better off in my case, going to futures. Now, you can do again, you can look at this however you please, but long story short, like Artie just said, extremely customizable however you want. Now, I just want to run over two more stats quickly. One being the average long equity return on the Aries, which is again 3 times tactical leverage. It's about 26%, and the bond returns about 14%. Meaning, every time this system, or I should say Aries, right, gets long for a regime, if it's long equities or long bonds, because that's all Aries is: long equities, risk on; long bonds, risk off. With the underlyings being bullish trend. If you get that long equities trigger, you're going to see historically we've seen 26%. Whereas if you get that long bonds trigger, historically we've seen 14% before that regime is done or that trade is finished. So those are great gains historically, right? So there's not much there to hate on or to shit on. Those gains are great. It's just a matter of being present and paying attention. And going forward, we're going to have these signals posted in the weather report every day. This way you can see what Aries is thinking real time. We also have a crypto portfolio called Astrius. We are gonna probably go over that at some point in the near future, but that remains distant. We're really gonna need a risk on regime and Bitcoin to be bullish for that. And as we start to see that progress, we'll break that out. Um, that again historically was more nuanced, right? So that was more of a just like this. Historically, I can't show you these same returns because things were a lot different. Drawdowns were averted. Um, Gains were multiplied with reinvested capital. It's just a different ball game. Can't show it to you, right? It would be unfair to compare this to something that again had my daily touch, where this again is going to tell us what to do every day. Um, and it's just easier to present going forward. And I think that's where we're going to roll this podcast up. If you have any questions, feel free to reach out to us in our Discord. You can join our Radar membership at our website, market-radar.com. And if you have Twitter and you want to follow us on Twitter, our Twitter is at Market Radar. Thank you so much for listening, guys, and have a great week.